A beginner's guide to stock investing. Start your wealth journey here. If the stock market seems daunting, this beginner's guide breaks down everything you need to know to start investing confidently. We'll cover key concepts in depth with concrete examples and suggested graphics for a video explainer. Let's build your wealth creation knowledge comprehensively. Stocks represent fractional ownership in a public company. When a private company first sells shares to the public, it's called an IPO. The stock market is where investors can then buy and sell these shares. Stocks are units of fractional ownership interest in a public company. When a private company wants to raise capital, it holds an initial public offering, IPO, and first sells shares of stock to investors. The stock exchanges like the NYSE and NASDAQ are public marketplaces where investors can buy and sell these shares after a company's IPO. Define your investing goals and time horizon. Are you investing for retirement in 30 years, or hoping to profit quicker to save for a house? Your goals shape your strategy. Before investing, clearly define your financial goals and intended time frame. Are you looking to build long-term wealth slowly for a comfortable retirement in 20, 30 years? Or are you hoping to flip stocks aggressively for profits in the next 5 years to save up for a house down payment? Your specific investing objectives will determine your overall strategy and approach. Research companies thoroughly before investing. Study financials, products, leadership, competition, industry trends, economic conditions. Informed investing reduces risks. Don't randomly pick stocks without due diligence. Research things like the company's financial statements, executive team, competitive advantages, market share, industry outlook, economic moat, and recent news. Additionally, assess overall economic conditions impacting the business. Informed investing decisions based on thorough research helps minimize risks and unearth promising opportunities. Diversify. Don't put all your money in one stock. Avoid concentrating too heavily in one stock. Diversify across sectors to minimize risk. While tempting to load up on one hot stock, construct a diversified portfolio across market sectors, asset classes, industries, and geographies instead. Diversification insulates you from events negatively impacting individual companies or narrow segments. Losing big on just one bad stock can devastate new investors. Diversify intelligently to minimize risk. Learn key investing terms and metrics. Master terms like PE ratio, EPS, market cap, volume, volatility, expense ratio. Fluency enables understanding. Fluency in fundamental investing vocabulary and metrics is critical before trading stocks. Understand key concepts like price-to-earnings ratio, earnings per share, market capitalization, trading volume, volatility, and expense ratios of funds. Consuming investing data, financial publications, and analyst reports will be confusing otherwise. Do your homework. Know your risk tolerance to construct the right portfolio. Can you stomach volatility, or do you need low-risk investments? Know yourself. Carefully consider your personal financial risk tolerance before investing in stocks, as they carry risk. If market swings cause anxiety or sleepless nights for you, stick with stable, less aggressive stocks and mutual funds. However, if you have an appetite for risk, allocating a portion of your portfolio to higher volatility growth stocks can provide greater upside. Know your comfort zone. Select a brokerage offering commission-free trades. Platforms like Fidelity, E*TRADE, and Robinhood offer free trades. Paying commissions reduces small investor returns. Instead of overpaying commissions, utilize reputable brokerages offering commission-free trading like Fidelity, E*TRADE, or Robinhood. Otherwise, transaction fee costs can rapidly diminish returns, especially for smaller investors. Save money and maximize returns by selecting fee-free trading platforms. Automate investing contributions for consistency. Set up recurring automatic transfers on a schedule. Automation provides discipline and reduces emotional decisions. Rather than investing sporadically, automate recurring transfers from your bank to your investment account on a fixed date each month. Automation provides discipline to invest consistently over time, regardless of market volatility or your emotions. Don't let procrastination or panic derail your plan. Reinvest all dividends and earnings. Reinvesting dividends and capital gains compounds returns over decades. Don't cash them out. To maximize returns over decades, continually reinvest dividends, interest, and any capital gains. When distributions are reinvested, That money can also generate compound returns versus being cashed out. Reinvesting creates exponential growth through long-term compounding. Use tax-advantaged accounts, like 401ks and IRAs retirement accounts, shield investments from taxes, enabling faster tax-free compounding growth. Contribute regularly to 401ks, IRAs, or other tax-advantaged retirement accounts which protect investments from taxes. This enables faster compounding growth over time versus taxable accounts. Do not miss these huge savings and growth opportunities. Stay patient during periods of market volatility. Ignore short-term fluctuations. Riding out dips avoids locking in losses. Time in the market beats timing the market. Expect periodic stock market volatility, but remain unshaken. Reactively selling during dips can devastate your portfolio. Stay confidently committed to your long-term strategy amidst turbulence. Patience and time in the market pay off. Keep learning to become a seasoned investor. Read books, news, blogs daily. Listen to investing podcasts. Join forums. Never stop increasing your knowledge. Make ongoing investing education a lifelong habit. Read books, reputable blogs, and business news daily. Listen to investing podcasts. Join forums to exchange ideas with other investors. Continuous learning is key to lasting success. The stock market is far less daunting when you break down the core concepts step by step. Now armed with a comprehensive beginner's guide, it's time to start investing confidently. Keep expanding your knowledge. As you journey through the ups and downs of the market, remember that acquiring wisdom from experienced investors can provide invaluable insights. Seek out mentors who can share their strategies and lessons learned. Participate in investment workshops and webinars to gain practical skills. Engaging with professionals in the field can help you refine your approach and build a solid foundation. Moreover, diversification is a fundamental principle that can't be stressed enough. Distribute your investments across various asset classes to reduce risk. A well-balanced portfolio can cushion the impact of volatility and potentially lead to more consistent returns over time. In addition, keep a close watch on macroeconomic trends and geopolitical developments. These factors can significantly influence market behavior. Staying informed about global events enables you to make informed decisions and adjust your investment strategy accordingly. Remember, investing is a journey, not a destination. Your financial goals may evolve, and your strategies should adapt accordingly. Regularly review and reassess your portfolio's performance. Be prepared to make calculated changes when necessary, but avoid making hasty decisions based on short-term emotions. In conclusion, embracing a patient and informed approach to investing is the cornerstone of success.